Good afternoon, everyone, and welcome to Stock Market Today. It's Ali Coram and Justin Nielsen here with a breakdown of the action in today's session and a look at this week. But today, Friday, September 6th, and we started off the week in a negative fashion, and we sure ended the week in a pretty negative fashion, Justin.
Yeah, for everyone that was saying it couldn't get much worse than Tuesday, guess what? Yes, it could. So on the Swing Trader status update, we had talked about it being the terrible, horrible, no good, very bad day. It just turned into the terrible, horrible, no good, very bad week. So we'll talk a little bit about the market, of course, and a few stocks that are holding up a little bit better, including ResMed, CubeSmart, and surprisingly to me, Palantir.
Yeah. All right. Well, we will take a look at those three stocks, but first let's analyze the major indexes. The NASDAQ today really taking it on the chin here, down almost 2.6% by the end of the day. And even looking at the intraday chart, closing basically at the day's lows. Meanwhile, the S&P 500 down 1.7%, was finding support at a key level, now sharply below it. We'll dig into that as well. The Dow down 1% today. It had been holding up better, but now also seeing some deterioration here in blue chips and the Russell 2000. This is your RUS in market surge, down 1.9% on the day, extending its losses after closing below the 50-day line in Thursday session. Justin, let's first go to the S&P 500 because it had been, heading into this week looking pretty bullish and holding up a lot better, looking stronger in its position versus the NASDAQ. But boy, how a lot can change in just a matter of days.
Yeah, certainly the case. I mean, it was just 1 week ago today that we were talking about the S&P 500 joining the Dow Jones Industrial Average and Russell 2000 in a power trend. That day marked 5 days where the 21-day was above the 50-day moving average line, and more than 10 days where the 21-day moving average line, the index was above the 21-day moving average line, the lows. So it had those elements. We were again, a lot of stocks looked good. The indexes looked good. The NASDAQ was maybe a little bit weaker, but the S&P 500, it was hard to get too bearish when the S&P 500 looked so positive.
Right.
So now, of course, a lot of those things that we were liking about the S&P 500 and the support levels that it was holding, well, not so much anymore. Certainly as it came down below that 21-day moving average line, that's certainly a shot across the bow, and that happened on Tuesday. So
Mhm.
really a shot across the bow for a lot of stocks, a
Right.
lot of indexes on that day. And if you didn't heed the warning, you kind of had 2 more days to maybe do a little bit of trimming for
Mhm.
especially new positions that maybe you weren't up that much on, maybe taking some profits on some stocks that were a little bit more tech related or coming down on their relative strength. But even yesterday, it was nice that the S&P 500 was at least holding that 5,500 level and right there at its 50-day moving average line, both kind of converging areas of support. So it really seemed like an important level. So today's action, really not great. We closed the gap that we saw just a few weeks ago, and you're kind of at a level where we were at late July. So it is kind of an area that you'd like to see it at least get support here. But the next stop is one of the things we look at is the close below a follow through day low. We're not there yet on the S&P 500, but it's awfully close. And beyond that, you really kind of have to look at, what is the next level? Certainly you could look at the highs of May that we kind of, right there. That might be another level where we could potentially see support. But then beyond that, you're potentially looking at a rally failure here or a bounce off the 200-day moving average line. So those are kind of some areas of interest right now.
hmm And I mean, as bad as today was, you're totally right. Tuesday was sort of that shot across the bow, definitely to be reducing exposure, especially if you look at what the NASDAQ did that day. It was already kind of on the bubble, in my view. So a lot of heavy losses in the tech space, especially Nvidia dragging things down on Tuesday. And we are below by quite a lot, Justin, the follow through day low on the NASDAQ that day, August 13th. So we are pretty close now on the NASDAQ to that 200-day line. Once
Yeah.
again, it's hard to believe it.
Yeah. And look, we do tend to favor the NASDAQ because we're looking at those growthier names. They do tend to fall in tech. But at the end of the day, that relative strength line was telling a very compelling story. And that was that the NASDAQ was turning into the
Mhm.
lagging index. And when that happens, you have to be aware of where are you located? Where is your concentration? And if it is in NASDAQ type stocks, you've got to rethink that when you see a relative strength line going into a downtrend like that. Um, at the same point where we were talking about an important support level that the S&P 500 was hitting, 17,000 seemed to be that level for the Nasdaq. It was right around that low of the follow through day that you mentioned on August 13th. It was right around some lows that got touched multiple times in July, and it was right at the highs of May. So again, a lot of converging areas there for the Nasdaq. And it was nice that although we came down very sharply on Tuesday, that we did hold for 2 days there. That
Not
didn't
so
happen
nice
today.
now.
Yes. So we held temporarily. So again, you have to be very careful if you were looking for a bounce. The 2 days following Tuesday just really didn't provide it. A lot of
Mhm.
times we'll look at like a 50% retracement of a bad day like that. Can you get up to at least the halfway point there? And we were nowhere close. It just really had no oomph to it. And even those days where it started strong. I mean, yesterday we were up
Mhm.
1.25%,
Right.
but it didn't last.
Yeah.
And when you can't hold on to gains and you close at the bottom of your range, it kind of makes these down arrow looks to the chart, and those down arrows are really kind of giving you a sense of direction.
Mhm. Okay, let's go to the Dow here. Was finding support at the 21-day line, now below it, and could be getting close to the 50-day line, Justin, and that round number at 40,000.
Yeah, and you have to remember that, look, the Dow Jones Industrial Average, it's price weighted, it's only
Mhm.
30 stocks. Um, but the relative strength line on this was very powerful. And let's not forget, just 1 week ago, we were talking about Dow Jones Industrial Average at all-time highs.
Right.
That was the headline. And now, sure, it's not off nearly as much as the other indexes, but 3%, you start to feel that, especially for an index that doesn't tend to move as much. And look, we're at those levels now where, again, if it doesn't get support here, uh, you could be looking at this going lower.
Mhm. And let's take a look at the Russell 2000, also well below its 50-day line now at this time.
Yeah, and so again, the S&P 500, the Russell 2000, and the Dow Jones Industrial Average all did have kind of those power trend looks to them, with the 21-day moving average line trending above the 50-day moving average line. But I will say that one of the things that is an early warning sign for your power trend is when you start falling below the 50-day moving average line. So that kind of puts that power trend under pressure, and we're now seeing that for at least the S&P 500 and the Russell 2000, not quite for the
Mhm.
Dow yet. But that is a big mark against it. So the Russell 2000 closed below that 50-day moving average line yesterday and just made more progress below it today. So that's a negative sign, and it's just kind of showing that for a while there we were asking ourselves the question. There were certain stocks that were holding up a little bit better. Was the market gonna drag those down? Kind of the bad was going to drag down the good, or were we
Mhm.
going to see those kind of hold them, for themselves? Right now, it looks like pretty much everything is getting dragged down.
Mhm. So we've spent a lot of time talking about the Nasdaq and S&P 500 and key levels that we're watching, because if you go back to earlier in the summer, we had the bad break, a V-shaped recovery. At least the S&P 500 getting very close to highs or a new closing high close to it, the Dow at highs, maybe the NASDAQ lagging a little bit, but coiling up potentially, and things just sort of breaking wide open here. Again, it looks like, Justin. So a lot for investors to navigate, for trend followers to navigate. Can you put this into historical perspective for us for in terms of how this rally stacks up versus other historical rallies?
Well, I'm going to share some information that one of our frequent podcast guests, frequent IBD Live guests has shared with us, Eric Kroll. I first met Eric at a meetup group out in Naperville, the Chicago area, a very big studier of markets. And he came to our very first market school and kind of took what we presented there and really ran with it. And what I like about this chart is that he went through and he just kind of classified, based on how much an index went up, how much a market went up over what period of time. He kind of started classifying them. Was it successful or not, based on
from a follow through day?
From the follow through day. Yes, exactly. Because that's our signal, right, to get in. So once you have that signal, how successful are you? And what he found was, hey, there are kind of these four classifications that he came up with. You had those life changers where it was really some phenomenal gains. You could really have some, strong stocks. It doesn't necessarily have to last too long, but it was long enough for you to make some money and a good chunk of change at that. Next, you had the money makers. Hey, these were no slouches. You made money. It was better than nothing, but it was maybe short-lived or not too much, kind of a more modest rally. Then you had the slogs, which were kind of a lot of back and forth action. And those can be very, very difficult to navigate because they look okay at first, but then you don't end up making that much progress. And then, of course, there's the whipsaws, which are the worst, where you have maybe some early strength and then immediately fail, or even worse, you kind of go back and forth from extremes, and those can be the most difficult to navigate, because every time you start getting optimistic, the market slams down, and then as soon as you start getting too bearish, the market kind of comes back up, and it's hard to get on the right side of either of these. And so you see those different classifications. What he did was he took the averages here, and the green line is your life changers, the average of the life changers, the money makers is the black line, the slogs are your orange, and then the whipsaws are your blue. And then he transposed what was happening in this latest rally. And at first, we had this really tracking on the life-changing trajectory, but it quickly changed, right? And so it went from that life changer to, okay, well, it corrected a little bit. It was going a little bit sideways, more, less like a life changer. And then now we're down. I mean, after you take into consideration today, this was what it looked like.
Take a big red marker,
right?
And draw down on that red line.
Yeah, add your note here. We're much more looking like a whipsaw now. And that's something that's important to kind of, you want to be aware of history and what is possible, but at the same time, you can't just trade the market that you want to have. You have to trade the market that you do have. And that's why you don't typically hear IBD making a projection of, okay, we think the NASDAQ is going to be at, 20,000, or the Dow is going to be at 50,000, by such and such date. We tend to just say, okay, this is what the market is doing right now, and this is how we're adjusting accordingly. Even, when we're looking at the NASDAQ, if we kind of go back to our market surge charts and take a look at, how it was coming in a little bit, we still were seeing support. So it wasn't time to give up on this yet.
Yeah.
But again, you have to be able to pivot very quickly as you get new data. And I would say Tuesday was an important data point for us that, hey, we need to start, doing something about our exposure level. And you saw that if you were reading the big picture, if you were following us on, the stock market today, you could kind of note how we were shifting our outlook on Tuesday, and we're shifting it even more now.
Exactly. And on IBD Live as well. I was doing a lot of selling on Tuesday, Justin.
And you were very open about that on Tuesday. People were getting a blow by blow in some cases.
Yeah. Uh, I mean, that's what trend following is about, right? If you're trying to get that outperformance, you want to try to be getting in at those different market turns, right? So we had uh, a dramatic turn in lower in early August. Then we had a dramatic turn higher in mid-August, and a little bit of a coiling up, looking like we were primed to go. But hey, that didn't work out, so we have to back away.
Yeah. And look, you can be doing the macroeconomic analysis. You can be looking at, oh, what does the Fed funds future say that is going to happen in terms of the rate cut? How much of a rate cut at the next meeting? Whether or not they're late or whether or not they're right on time for a soft landing. There's a lot of that type of analysis that you can do, but recognize that there's often a lot of disagreement from very smart economists on what a lot of that means and how to interpret that. But for us as trend followers, when we look at the chart, it's pretty cut and dry. Are you in an uptrend or in a downtrend? It's something that a lot of times you can ask an 8-year-old, hey, what direction does this look like it's going? And they can answer you.
Right.
Whether it's going up or down. And right now, at least on the short term, any 8-year-old will probably tell you this looks like a downtrend.
Yeah. I also want to point out some interesting data that just came through from our Dow Jones market data team. For the S&P 500, down 4.25% over the last 4 trading days. That's its worst first 4 days of September since 1946, when it fell 4.86%. In terms of the NASDAQ composite, it fell 5.77% over the last 4 trading days. That's its worst first 4 days of September since 2001, when it fell a little more than 6.5%. Justin, your thoughts? Bad
Yeah.
start to September.
Yeah, that's just for September. And
Right.
earlier, our Dow Jones Markets research team was letting us know that in terms of how bad Tuesday was in terms of any start of any month. I mean, it was
Mm,
kind of for the Nasdaq. I think it was at least back to 2015 or something like that. So again, some pretty bad action that we've seen this week, and so I think it's notable, especially when you're starting to talk about time frames like 2001. But you also have to make sure that you're not getting overly bearish,
right.
because you have to put it in
Put it in
context. What was
context.
going on in 2001? Well, we were, at least for the Nasdaq, we were in a dot-com bubble. That was really correcting.
Right.
Um, and so a lot of people could argue that we're in a very different position right now. We haven't come off nearly as much as we already had by 2001 from our 2000 top in the Nasdaq. But at the same time, I think it does help you put in context how bad this was. You don't want to necessarily put your
If-
rose-colored
yeah.
glasses on and say, oh well, I've seen worse. You really haven't for a while. So
Yeah. So we'll continue to adjust as we get new data. And Justin, you also wanted to take a look at some inverse ETFs to give some added perspective. So here's a look at PSQ. PSQ, pulling it up here. So this is the the inverse of the NASDAQ 100 here, and almost looks like a bottoming base with some early entries that one might look at from Tuesday and today.
yeah. Now, I'm not in the habit of buying things underneath
Yeah,
the 200-day moving average line, but man,
it's a different
it's
animal,
above the
kind of.
200-day moving average line and it starts looking interesting, right? So, in the same way that we asked the indexes to do a number of different things in order to get us interested, it had to get above the 21-day moving average line. It had to get above the 50-day moving average line. It had to, start making higher lows and higher highs. Well, all of those things are happening with the inverse indexes now. So again, the one remaining thing I think that would make me feel better is, if I were looking at this in a bullish way, which again, inverse, you have to switch it on its head, so it's more bearish. But if this got above the 200-day moving average line, that's really the only piece that's missing here. Now, again, we don't want to get overly bearish here, because
Yeah.
a lot of times when you have this kind of move to the downside, you can get a bounce. You can get a
Mhm.
bounce, and um, a lot of news could come out in the next few weeks that could turn things around. But again, you don't want to necessarily try and project that onto the market. Based on what we're seeing right now, there's a lot of reasons to be cautious. There's a lot of reasons to either reduce exposure, hedge your exposure, and the inverse ETFs are one way that you might do that. You might take a little bit of, if there are some positions that you wanted to hold, inverse ETFs are one way in which you can take some pressure off your portfolio by having a hedge for a little while to kind of offset the downside that your portfolio may be hitting. Now, the one thing I would say is that might have been a better trade on Tuesday,
I was about to
than
say.
today. Yeah, you have to be
Yeah.
very careful because a lot of times, again, when you've had such a bad week, it's not unusual, even in a bear market or a severe downtrend, to get a very big bounce.
Mhm.
And again, it just kind of speaks to the extra volatility that can happen when the market starts getting these kind of hits. You already saw it, two very volatile days, two very big spreads. You can see more of those, and they can be on the upside, but not necessarily tell you that you're out of hot water.
Right. Yeah. I mean, buying as close as you can to the moving averages as you're starting to see that change in trend is the way to go, I think, with managing risk there. Okay, Justin, do you want to take a look at some sector ETFs? We can sort them by best to worst performing. And I'm going to go here to
And
my
there was definitely a
sector
lot to look at
ETF.
on the negative side today.
Yeah.
Of the
Yeah.
11
Yeah.
sector
Best.
spiders, the
There's not a
best
whole
you
lot
could
of
get
green.
was 0.
Yeah. Best you can get a
Yeah.
zero. So here's
And
XLRE.
you know what? This is actually a good reminder for folks that sometimes the best relative performer is the one that's losing the least. And
Mhm.
so a 0 is actually good. And that is one of the reasons why sometimes our best defense is raising cash,
Yep.
because having flat action is better than taking, big hits to the downside. And so the XLRE, look, just looking at that relative strength line, this is still looking very strong. One of the stocks
Mhm.
we're going to talk about is in this XLRE group. If you look at XHB or ITB, two ETFs that are kind of on the home builders, both of those, that they don't look great in terms of the way they closed today, but they look much stronger than a lot of other
Mhm.
things out there. And again, you see that with the relative strength. But if you add in a lot of the REITs, which XLRE does, then you get an even stronger look. This is certainly one that I think is worth watching, because with the 10-year treasury yield going down, which we didn't even talk too much about
Yeah.
that, but it is important, how much we've come down here on the 10-year treasury yield. It's worth noting that could have a positive effect on
Mhm.
XLRE, and right now it looks like it is.
Yeah. Look at that close too, undercutting a lot of the areas going back quite a ways, which not surprising given that we're expecting to see rate cuts. But I think that's the question now is what kind of cut are we going to get? So
That's $1 million question. And I'll be honest with you, you could give me the answer right now, and I don't know that it would
the
help me,
reaction, yeah.
because it really is the market reaction. Because if the Fed feels like they have to cut more, that usually is telling you that they think that the economy is hurting more, and that the likelihood of a recession, a harder recession, the,
Mhm.
the the chances are increasing. So we kind of have to find that little Goldilocks area where they're cutting in a stimulative way, but not because it's panic.
Right. Well, so we looked at XLRE. Any other sectors of note right now? I mean, staples, which is very defensive. Look at that relative strength
Yeah.
line surging. Healthcare reversing lower for the week, but it's been outperforming. But as you said, you can have a relative winner that's an absolute loser. I know Ed Carson always loves saying that, and I love that he reminds us of that. XLU utilities, another defensive area, reversing lower for the week, but relative strength holding up. Industrials kind of having a tough week here, Justin. That relative strength is
Yeah.
still holding up, but again, I mean, it was a tough week for the S&P 500. So uh,
Mhm.
this could
And
this was still down, but a little bit stronger than the S&P.
right, and just to be clear, those first 4 that you went over, XLV, XLRE, XLU, and XLP, these are all very defensive, right?
Hmm.
So it's worth noting that that's where the relative strength lines are strongest.
Yeah.
Now we're going to get into where they're weakest, and starting with XLI, and it just kind of gets worse from there. XLE, that's been very volatile, lately, but is in an overall downtrend with that relative strength. XLB not looking much better. And then as you get, lower in there, XLF, I think, has been a little bit more, it was down today, but it's been holding up relatively well. And that relative strength line kind of shows that. But then as you get into like XLC, XLY, and XLK, this is where you're getting a little bit more of that tech exposure,
Hmm.
and seeing a little bit more of that, turned down. XLY was helped a little bit by Tesla, which, it's I think Tesla's like a 20% weight in there, and you saw that get above the 50-day moving average line recently, and have a little spike in its relative strength line. But again, it seemed very short-lived. As bullish as it looked yesterday, you have to adjust when
Right.
things do not look the same the next day.
Hmm. And then we already looked at XLK, and that's the end of the list. So in terms of the strongest, back to what you were saying, XLRE, XLP, XLU, and XLF, it kind of seems are the four strongest areas right now. What do you think?
Yeah, and then XLRE. Did you say that one?
Oh, I
XLRE,
said it. I
XLP.
just didn't pull it back up. But
Okay,
yes,
okay.
for sure.
So XLRE, XLP, XLU, um, and then yeah, XLF definitely deserves a
Hmm.
spot there. And XLV, not too bad. But
Yeah.
with XLV, be careful, because if you pull up like XBI, which is the biomed biotech area,
Hmm.
um, there has been a little shot across the bow there,
Yes.
where this is now below its 50-day moving average line. You had a really tough Tuesday. Not as dramatic today, but still, this is looking like it could run into some trouble.
Okay.
But one of the ones that we didn't mention, and it's not an ETF, a sector spider ETF, but let's just reiterate, cash.
Yeah.
Cash is okay too. If you're
Yeah.
raising cash, to Ed's point, absolute, relative winners can be absolute losers. With cash, at least you're not losing.
Right. Yeah. So instead of rotating to some of these
Except for
defensive
inflation, but
areas,
that's a different thing.
yeah, yeah. Sometimes it can be okay to rotate to these more defensive areas, but other times, as you said, instead of just trying to chase, what's working, if it's not really your style, or if it's out of position by the time you notice the strength, yeah, you might just be better off
Mhm.
keeping that powder dry and waiting for the right time that works with your style and setups that favor your trading style. Okay, digging a little bit deeper into the themes, of course, technology, we know, led the declines this week. Just want to quickly take a look at SMH representing the chip sector. Look at this, Justin, a close below the 200-day line. And I think this is even a close, it's right at where it was closing in early August. So almost a total round
Yeah.
trip here, roller coaster month.
And look, SMH was actually not as strong as, some of the
Mhm.
Nvidias and Broadcoms would have had you believe. Those were
Right.
definitely helping prop up this index quite a bit. Nvidia and Broadcom both got above their 50-day moving average lines, whereas SMH came up to its 50-day moving average line and got turned away. I mean, that's a lot of times what we're looking at for shorting opportunities.
Right.
Now, that's not to say that you should short here, because it's again a little bit late here for SMH, and it would have been hard to do that with some of the leading stocks doing a little bit better in the semiconductors. But certainly, I think you have to pay attention to the fact that that 50-day moving average line was an area of resistance for the semiconductors. 250, that was an area of resistance, and the fact that we're below our 200-day moving average line on this, even
Mhm.
though Nvidia and Broadcom and some of those stronger ones aren't yet, there's enough that are pulling this down that you really have to be very careful. And look, that does say something about the weakness in
Mhm.
tech as well when you
Right.
get the semiconductors looking that
Mhm.
ugly.
Yeah, here's one more. Here's IGV representing the software sector. This is basically keeping pace with the S&P over the last month plus.
Yeah. And this is a reason why I don't want to get too bearish because I mean, looking at this, it's a cup with handle. You could see a situation where this kind of
Mhm.
turns around. I'd say kind of the same thing for a few of the mega caps that aren't looking too bad, like Meta. You could kind of say, hey, this is potentially forming a handle pattern here, and if we broke above a downtrend here, would you be interested? Yeah, I might. If it got support here at 500 or at the 50-day moving average line. So you could see a situation where things turned around and you would want to be ready for that. Now, that's not to say that it is going to happen or not, but in your scenario analysis, I think you have to be open to the opportunity if it comes.
Okay, let's go to those three stocks to watch. Here's RND, Justin.
So we talked about how XLV and some of these medical stocks were holding up a little bit better, and RMD certainly has the strength in its relative strength line. And for as ugly as this week was, the fact that RMD could hold so tight right below 250, this is something that really kind of attracted me. If we go to the weekly chart, we talk a lot about 3 weeks tight as being a positive thing. This right now is only 2 weeks tight, but look at how it just didn't give any ground up. And it only came to the basically the 50% level of last week, which was a very strong week for this stock. So it's just not giving up any ground. It's holding tight to last week's close. So if it can continue to hold tight here, this will by definition have increasing relative strength if the market continues down, and that just makes it look more attractive. Now, it also does look at that earnings line. It has the stability, earning stability here. It's got a 13% EPS growth rate, which it's not spectacular. It's not blow the doors off, but that earning stability of 5, the lower number means more stable, and you can see that on the earnings line. That's something that's also worth noting.
Mhm. And what I also like about it, Justin, is the fact that not only did it show relative strength this week, but also when the market was really crumbling in early August as well. This was
Mhm.
bucking the weakness fabulously during that time as
Yeah.
well.
Yeah, and a lot of times these are the ones that are the strongest in a downturn are the ones that become the strongest in your next upturn. Now, of course, there are sometimes those defensive names that are favored only because they're not going down as much. But this one, does have some fundamentals behind it. That's some pretty good earnings growth that it's got under its belt. A little lackluster on the sales, but still overall some pretty good fundamentals.
Okay, we'll keep an eye on it. Next on the list, speaking of that XLRE strength, here's a look at a REIT, CubeSmart, ticker here CUBE. Same story a little bit here with that strength this week. If you were just looking at this chart, you would say, what sell off?
Yeah, exactly. And here again, if you go to the weekly chart, what do you see? You see some really tight weeks. This is your 3 weeks tight closes right here. So, this is what ResMed could become. And we just had a few other 3 weeks tight the previous, previous month or so here. This is in the storage area, the self storage area. And if you look at a number of these stocks in this area, NSA, EXR, they all have kind of a very similar look. So these storage ones have some really strong relative strength lines. Again, they're in that XLRE that has a lot of REITs in it that are holding up better than most. And if you go to the weekly chart, another thing that you'll notice on our market search, charts will also tell you the yield. In this case,
Mhm.
you've got a higher yield than the S&P 500 at 3.94%. That's nothing to sneeze at. Now, I don't get overly enthusiastic and say, oh, well, at least I'm getting a yield, because who cares about a 4% yield if your stock goes down 10%?
Right.
But it is something that obviously the market is favoring right now some of these stocks that are providing yield, like XLRE, and the stocks that you would find in XLU.
Mhm. Okay, and with all the destruction in tech this week, Palantir holding up better than a lot of tech stocks in terms of that support at the 10-week line, down about 3.6% for the week, it looks like, but really hanging in there nicely if you look at the daily chart here.
Yeah, so as ugly as Tuesday was, it still only came down to its 20-day moving average line, and then the very next day it had an upside reversal. So yes, it didn't make progress into that, that drop, but it really is showing that it's holding. It's not
Mhm.
losing that support. So this support area around 30, which just so happens to coincide roughly with the top of that last area of resistance at 29.83, and is right there around its 21-day moving average line, I think is pretty important. Now, I did talk to Matt Caruso. He was on the podcast this week, our first, by the way, live podcast that we did Wednesdays at
Yes.
2 Pacific, 5 o'clock Eastern. And this was a stock that he brought up. I said, look, this volatility is
Mhm.
usually something that scares me off. Every time I buy a breakout, it just, kind of
Yeah.
falls apart.
Subtle
But I
character
think,
change, perhaps?
yeah, maybe. If this starts acting like a very tight stock, this is something that I might get interested in again. So I think the waiting and seeing if this can remain tight, and that relative strength also very strong. A lot of AI related stocks have been taking hits, but this does have some pretty strong AI exposure, and it's not taking the hit. So you got to wonder what's so
Mm.
special about this one. Maybe it's worth doing a deep dive on the fundamentals.
Yeah. Well said. Okay, before we wrap, in the spirit of Webby, who's not here with us today, I wanted to take a look at a historical precedent because looking at the NASDAQ here, Justin, my mind started having these sort of thoughts and tracing out on the chart here. Hey, could we be in for a three waves down scenario? Of course, I would love to see the market go up every single day. I'm not a bearish person by nature, but just I can recognize patterns and I love scenario analysis, not predicting, but analyzing different scenarios that could unfold. So, given where we are with the market peaking in July, we're now in early September. I started thinking about the market in 2023 and the three waves down that we saw in the August to October timeframe. So, let's rewind the clock and go to 2023 on the NASDAQ. And I'm going to forward a couple of days um, because in spirit, today's action kind of reminded me of what we saw in mid September last year, not to the tick, but a
Mhm.
lot of similarities in my perspective. And this did turn out to be a three waves down that finally culminated in that strong early November rally that we
Yeah.
saw for the rest of the year. What are your thoughts?
Well, and just to be clear, I was, when you brought this up in our stand up meeting this morning, I was like, wow, that well done, Allie. And I would say that the way that we closed just more affirmed what you were looking at. It looks even more so now than it did this morning. So well done on your part recognizing that. But yeah, I think that you do have to train yourself as you're looking at a lot of different charts, as you kind of survive a lot of different markets. Start asking yourself, does this remind me of something? And kind of play out, okay, what happened in that case? How did I handle it? Were there things I could have done better? Now, the one caution on using a precedent is always be
Yep.
very quick to recognize when a precedent is no longer holding. Don't plant your flag and say, okay,
Yeah.
I'm sticking
See
with
you in
this.
November. Yeah.
Yeah, right, exactly. So yeah, it's something that is important to kind of and Charles Harris, a big believer in precedent. If you ever go into his office, he has binders full of precedents where he will kind of say, "Hey, this reminds me of something," and then he'll have all of these examples that are very similar looking to that.
Mhm.
But he was also on the podcast recently, and he does give the warning. You have to
Right.
always be careful of when you have a strong conviction, you have to be ready to pivot from it if you get different data. So, Allie, I'm right there with you right now. I think it looks very similar.
Who
And
knows?
while I'm also with you, I don't want to see that third wave down.
Yeah,
I don't want to see that kind of destruction. At the same time, what would that look like? Well, we could get an undercut of that 13,161, another rally, and then kind of another
Mhm.
test of that 50-day moving average line, and possibly some more destruction. So that's what it could unfold as. And I think you have to be ready for that in a bearish case. And also, as bearish as that might be, in the back of your mind, you have to, as you said, Allie, kind of keep that bullishness, that optimism there too, because recognize that these three waves down offer great opportunities. I mean, think of
It
how
sure
great the
did.
opportunity was from November 1st follow through day
Right.
through March, or even through
Mhm.
the this year, to date. If you were quick to take some of your profits, as the market started rolling over, then you still are probably looking at a pretty good year. And if you can just do that, take advantage of it when it's on the uptrend, don't get too much damage on the downside, then that's going to, over time, really lead to some spectacular performance.
Absolutely. Yeah, you gotta be ready to switch gears, and I think that scenario analysis definitely helps keep an open mind, instead of just having a bearish mindset or a bullish mindset. And just really quickly before we wrap, in terms of studying this for the future, some of the similarities, it wasn't as dramatic of a break, but we did break that 50-day line somewhat sharply, sharp recovery, then some coiling around converging averages, including the 50-day, and then this day here, let's get the date, 9:15, kind of similar to Tuesday, and then
Yeah.
again today, pretty similar to what we saw on 9:20. And yeah, that did unfold into a three waves down. Same sort of time period from a seasonality perspective. That's not something that we always place a ton of weight on because we like to be so flexible. But I know a lot of market watchers and traders that we respect, whether it's Joe Fahmy or Jeff Hirsch. They like looking at the seasonality, and even Mark Minervini, and layering that into their analysis. So I think something worth studying here.
Yeah, it's good to have it in the back of your mind. Again, it's a data point, and you have to kind of put all of the data points together to kind of build a story for yourself, to understand what scenarios can take place, what the likelihood is, and to know when it is bucking that normal trend. And that's where you can kind of start asking questions like why and everything like that. But at the end of the day, the chart is going to tell you, hey, something's happening that's different. And that's why we say price rules above all.
Right. And I think no matter what unfolds from here, we're going to be keeping a very close eye on those pivotal turning points in the market, because that is where you can have the potential to make a lot of money. So, just like we
Yeah.
did in November of 2023 and into the first number of months of 2024 till we peaked in the July timeframe, keeping an eye on those turns and the trending markets. That's really what can help you go a long way as a trader.
Yeah. And look, this is one of the reasons why, Jim Ropel, who you've chatted with a lot, he often says, hey, I've got a number more rallies in my lifetime, and I think that's, again, that mindset that you have to have is, as ugly as things might get, you got to remember that there is another rally around the corner. And, that's how you level up with
Yep.
either your fund money, your retirement money, your goals, your charities, whatever it is that's important to you. The way that you level up is by taking advantage of those rallies when you have them, and not losing too much on the downside when things turn. So yeah, no matter what happens, those two rules are going to be paramount.
Great. Well, thank you so much, Justin. And thanks everyone for watching. Coming up next week, Justin is going to be host of IBD Live on Monday morning, investors.com/IBD Live for all the details there. I'm going to be on Barney and Company in New York City in studio with Stuart Varney, 9:25 a.m. Eastern on Monday. So I will see you there for that. And then the IBD Live crew has you covered on Monday with all the twists and turns of the market. We may need to buckle up for another interesting week, Justin.
Yeah, and look, there's a lot that is, going to be happening this month. You've got on the geopolitical side, debates. You've got a Fed meeting. There's a lot that is going to need to be deciphered and analyzed, we're going to be here for every
Yes.
single one of those events.
Yes, absolutely right. Well, thank you again, Justin. And thanks to everyone for tuning in. We'll see you back here next week.